Good evening, everyone. Thanks for tuning in to Tax Talk with Marquette Leggett. I am so excited to talk about tonight's topic of earned income credit. So listen, stay tuned as we dive in. Wow, the earned income tax credit. Most of us know this credit because most of our refund comes from this credit. I am so excited to actually explain this because we are benefited by this credit almost every year. But do you really understand or know what this credit is? See, today we're going to talk about this credit in detail. See, the earned income tax credit, the EIC or the EITC, is a refundable tax credit for certain people who work and have earned income. The maximum amount of the EIC in 2019 is as follows. If you have qualifying children, your maximum credit is $529. If you have one qualifying child, your maximum credit is $3,256. If you have two qualifying children, then your maximum credit is $5,828. 3+ qualifying children gives you $6,557. And again, these numbers are based on 2019. Now, earned income is a criteria you have to have in order to get this tax credit. This earned income will include wages, salaries, and tips, union strike benefits, long-term disability benefits received prior to minimum retirement age, net earnings from self-employment, non-taxable combat pay, only if elected and included in taxable income. Now, earned income does not include interest and dividends. It does not include pensions. It does not include Social Security. It does not include unemployment benefits. It does not include alimony. It does not include child support. And it does not include pay received while working in jail. Now, a taxpayer will base the credit on AGI if lower than the earned income. Now, who may claim the EIC? To claim the EIC, taxpayers must meet all of the following. Investment income must be $3,600 or less for 2019 or for the previous tax year. Married taxpayers must file a joint return, MFG. In other words, if you are married filing separately, or MFS, you cannot claim the earned income credit. Now, taxpayers and all qualifying children must have a valid Social Security number. In order to claim this credit, a taxpayer must be a U.S. citizen or resident alien all year, or a non-resident alien married to a U.S. citizen or resident alien and filing a joint return. Now, the taxpayer cannot file Form 2555 related to foreign earned income. The taxpayer cannot be the qualifying child of another person. Now, if you are a taxpayer with no qualifying children, you must meet the following criteria. You must be 25 but younger than 65 by the end of the year. You must live in the United States for more than half of the year and not qualify as a dependent of another person. So it is possible for you not to have qualifying children and still receive the EIC. Taxpayers with a qualifying child must meet the relationship age and residency test. So if you are a taxpayer and you have a qualifying child, there are 3 tests that you have to meet. One is the relationship test. Now, to be a qualifying child, a child must fall into one of the following categories. That child must be a son, a daughter, a stepchild, a foster child, an adopted child, or a descendant of any of them. It also could be a brother, a sister, a half-brother, a half-sister, a stepbrother, a stepsister, or a descendant of any of them. For example, a niece or a nephew. They must also pass the age test. A qualifying child must always be younger than the taxpayer or the spouse of the taxpayer, if filing a joint return, must be under the age of 19 by the end of the year, or be a full-time student under age 24 at the end of the year. Permanently and totally disabled at any time during the year, regardless of age. Now, you also must pass the residency test. The child must have lived with the taxpayer in the U.S. for more than half of the tax year. Now watch this. Sometimes a child meets the rules to be a qualifying child of more than one person. Here's where it gets tricky. However, only one person can treat that child as a qualifying child and claim the EIC using that child. Taxpayers can choose which person will claim the EIC. If the taxpayers do not reach an agreement and more than one person claims the EIC using the same child, then there's a tiebreaker rule that applies. And the parent with whom the child lived the longest during the year receives the credit. If the child lived with each parent the same amount of time, the parent with the higher AGI receives the credit. And this is something in life that we run into a lot. You have two parents, maybe have split up, maybe have divorced, or a situation going on, or just two people trying to claim the child as a qualifying child for this earned income credit. Well, when you have two people who are claiming this child at the same time, there's a tiebreaker rule that goes on. And this tiebreaker rule that applies just states that whichever person, I want to reiterate this part here, taxpayers can choose which person will claim the EIC, but if the taxpayers do not reach an agreement and more than one person claims the EIC using the same child, the tiebreaker rule applies. And the parent with whom the child lived the longest during the year receives the credit. That's the first rule. The second one, if the child lived with each parent the same amount of time, then the parent with a higher adjusted gross income, or AGI, receives the credit. Now, a taxpayer uses Schedule EIC Earned Income Credit qualifying child information to give the IRS information about their qualifying child. Paid preparers of federal income tax returns or claims for refund involving the earned income credit must meet the due diligence requirements in determining if the taxpayer is eligible for or the amount of the EIC. Now, if a taxpayer fails to do this for a return filed in any year, you have to pay a penalty of $530 for each failure. This is why we ask questions and we do our due diligence. Now, as we always say, we are not the tax police, but we do ask specific questions, and there's an honor code and an honor system and an ethics code that we do speak about and we do talk about. So if you give us the information, we take the information, we take your information for truth, and we apply that truth in. But if we don't do the due diligence and we just take your word for it and we'll believe it, we are fined as taxpayers per incident. And that could cost, okay? Now, there is a disallowance of the EIC and certain other credits. Certain errors may cause the IRS to deny a taxpayer the earned income credit. If the denial is because of taxpayer error due to reckless or intentional disregard of the rules, the taxpayer cannot claim the EIC for the next 2 years. If the error is due to fraud, the taxpayer cannot claim the EIC for the next 10 years. Now, a taxpayer who wants and meets the requirements to claim the EIC must attach Form 8862 to his return if the EIC was reduced or disallowed for any reason other than a math or clerical error for a year after 1996. A taxpayer can claim the credit without filing Form 8862 if he meets all the eligibility requirements and either of the following applies. Now, after the credit was reduced or disallowed in an earlier year, number one, the taxpayer filed Form 8862 or other documents, and the credit was then allowed. Or if the credit was not reduced or disallowed again for any reason other than a math or clerical error. The taxpayer is taking the EIC without a qualifying child, and the only reason the EIC was disallowed in the earlier year was that a child listed on the schedule EIC was not his qualifying child. These rules are set in place to make sure that we are following the guidelines to receive this EIC. The Earned Income Credit is the biggest refundable credit that we can receive as a individual of the United States. We do not want this Earned Income Credit, to be disallowed. So it pays to have a professional come in and do your taxes, just to make sure that the right forms are being filled out so you don't fall into any of these categories. Married filing separately is the worst filing status to fall into because it takes away the biggest refundable credit, which is Earned Income Credit. Please do not make the mistake of filing MFS due to the lack of a proper instruction when it comes to taxes. It will take away so many credits and benefits, and you do not want that to happen. So earlier, I had talked about possibly receiving some of that EIC throughout the year. Well, to quickly answer that question, you really cannot receive the EIC throughout the year. But here's how the EIC can be utilized and affected to receive more income. Now with COVID-19, there are many people out there who want to know, how can I get more money into my check every week, every 2 weeks, every month? Well, there's a way. You can elect to be exempt from federal taxes for a period of time. Why would I do this? Because there's a publication 1040 and 1040 SR that has the tax tables. So in order to use the tax tables, you have to look at your income and line it up with your filing status, and where the two meet, that is the amount of taxes that your income is actually taxable every year. How many know that if you make $23,000 a year, then you are not taxed at that whole 23? There is a way to actually see how much of that income you are actually taxed at. Therefore, you can balance out how much you're giving the IRS and still receive your Earned Income Credit. That's right, you cannot pay the IRS and still receive your Earned Income Credit. Now, this only applies to up to about $55,000 a year. So if you're someone who makes more than that, then obviously you're not going to be able to utilize this as much. Now, what do I mean? I'm going to use the IRS's own example. Mr. and Mrs. Brown, they're filing a joint return. The taxable income on Form 1040, line 11B, is $25,300. Now, first they find the $25,300 to $25,350 taxable income line, and then they line it up with the married filing jointly, and that's your tax. So in other words, if you have a household or an individual tax, preparer, and let's say both of you all make $50,000. So you would go to your tax table for that combined, let's say $40,000 apiece. So you have a total of $80,000. Now the tax table only goes up to $99,000. So you will have to, look at your own personal situation from there. But let's say a combined income of 80, or you as a taxpayer, let's go down a little bit. You as a taxpayer has an income of $50,000. So on the tax table, you can use that. You take the $50,000, and you see that if you are married filing jointly, then you are taxed at a year of $5,615. So now you can take the money. See, here's what I try to tell people, okay? You're only receiving at the end of the year what you gave the IRS. When you pay taxes, what is actually happening is the IRS takes your money and they reinvest it into different things, and then they pay you back what they took from you. So in essence, what is happening is the IRS is making money off of what we give them, or they're using it, and the United States is using it, and off of what we give them, they're making money, and then they're paying us back what we lent them through taxes. So when we are looking at taxation, we have to understand that we're only getting back a portion of what they have made off of what they took from us. That money is being reinvested, it's being reinventured, it's being re-given, and it's making millions upon millions, and they're giving us back what we gave them. So why are we receiving $5,000 and $10,000 back when we're only taxable or taxed at $5,000 or $6,000 for the year? Because we are overpaying in taxes on a yearly basis. People are overpaying in taxes on a yearly basis. And this is what happens when we don't have the knowledge and the understanding that we need in order to effectively look at taxes. So what I did was I wanted to find out exactly how much I actually owe. So I looked and used the tax tables as far as they relate to the earned income credit, and found out that at $50,000 a year, which I made at one point in time, I only owed $5,600 and something in taxes. So what I did was I went exempt for half the year or however long to receive that money back in my household, and then I made sure that I paid the $5,600 in federal taxes. So then I came out of exemption to make sure that that amount was paid. If you take that amount and you half it up or you divide it by 12 months, it lets you know how much federal taxes you should be paying a month versus what we have been taking out a month. So hopefully this information tonight has helped you. If you want more information on any of these topics, please comment below. Tell me, what do you think about this theory of getting money back through the year? Comment below. What do you think about getting money back in the year? Thank you and have a great night. And this has been Tax Talk with Marquette Leggett.